In a low interest rate world, investors are desperate for income. But when you buy an income producing investment, you're getting a lot more than just the dividend. Here to talk about it is Brendan Conway, who writes our Focus on Funds blog. I'm Jack Otter, editor of Barron's.com. So Brendan, let's talk about this interesting post you have today on this Vanguard fund.
Yeah, so Jack, there's a really interesting fund out there. The name of it is Vanguard Dividend Appreciation. The ticker is VIG. That's V like Victor. And what this thing does is it's built to own companies that have paid steady dividends and have increased them over very long stretches of time. Now, Sam Lee at Morningstar, who's one of my favorite analysts, took a deep look at this morning and basically showed that although it has the word dividend in the name, it's actually about quality stocks, owning quality.
And so we should point out that the yield is only around 2%, which isn't that much better than you'd get from the index, but there is this other element there. Explain what quality means.
So quality means essentially companies that are profitable and that you can more or less count on them to continue being that way, to be really solid. And warning to the viewers, this gets kind of deep into the nerd land, but
let's give them a good reason to listen. You know, right now, the glamour stocks, the Teslas, the Facebook, the Twitter, we're not sure about their profits, and those stocks have been punished big time. Biotech rocketed up, now it's falling hard. So this elusive quality called quality is worth taking a look at and figuring out how you can get it. Jeremy Grantham, for one, says that quality stocks is the one area of U.S. equities that he is long right now, that he likes, that he thinks will do well in the coming years. So explain to us how you get that.
Yeah, so this is a fund that has companies like 3M and it has ExxonMobil. What Lee did that I thought was so interesting is he took this factor, this investing factor, which basically means a way of explaining how a stock or a group of stocks deliver what they deliver to investors, something that's called quality minus junk. And what this means, it was a concept that was developed in part by Cliff Asness, a famous hedge fund manager. It means that owning this ETF is a lot like owning a bunch of high-quality companies, but also being short their opposite number, namely this stuff that is rocketing higher and then plunging, and, you know, firms that have uncertain earnings.
Now, what's interesting to me is when you were describing all this, I'm thinking of a study of Warren Buffett's his alpha, how he was able to add value, and it sounded to me very similar to what you're talking about, that he was able to buy quality at a low price, wait forever, and therefore outperform the market handsomely.
Yeah, and you know, Jack, that's really what this fund does, and to me, it really just underscores how there are dozens and dozens of ETFs on the market, and even more other types of funds that have the word dividend in the name, or they have income. But what you're actually getting, even if you just bought it for that 2%, 3%, 4%, you're getting something else that's in there. And in many cases, you end up with so-called value investing, which means basically you're owning attractively priced stocks. Quality doesn't necessarily mean that it's attractively priced. It could be a very profitable company that everyone wants to own, but you can count on it. And this fund in particular, I think, is interesting because the stocks in it went through the financial crisis, and none of them cut their dividend. That's one of the requirements of this fund, is to not cut it.
That's pretty impressive, not cutting your dividend in 2008. And I think you said the fund, while of course it lost money in 2008, it didn't lose nearly as much as the broader market.
Yeah, the fund lost 27% in 2008, which compares to, I think, 37% for the S&P.
As Warren Buffett said, he'd rather buy a wonderful company at a fair price than a fair company at a wonderful price.
That's right, Jack. And in fact, the guy Lee, who I quoted, quotes that exact line.
We're on the same wavelength.
Yes.
Thanks, Brendan.